Something historic just happened on Wall Street, and whether you own a single share of stock or not, it may already be affecting your money. Let's start with the basics, because this story only makes sense if you understand what an IPO actually is. IPO stands for Initial Public Offering. According to financial institutions, including Fidelity and TD Investing, an IPO is the process by which a private company sells shares of itself to the general public for the very first time. Before that moment, only a small circle of founders, employees, and private investors, think venture capitalists and hedge funds, can own a piece of the company. The IPO is the door that opens that ownership to everyday people. Here is how it works in plain language. A private company decides it wants to raise money by selling a portion of itself on a public stock exchange. It hires a team of investment banks to advise on the process, determine a price per share, and manage the sale. The company then files a registration document with the U.S. Securities and Exchange Commission, commonly called an S-1, which is essentially a legally required full disclosure of the company's finances, risks, and business model. According to Robinhood's own IPO risk disclosures, this document is critical reading for any investor because it lays out the terms and the risks in detail. After the SEC reviews the filing, investment banks take the company on what is called a roadshow, a series of presentations to large institutional investors like pension funds and mutual funds. Those institutions then place orders, and the final price per share is set based on demand. On listing day, shares begin trading on an exchange like the Nasdaq or New York Stock Exchange, and from that point forward, anyone with a brokerage account can buy or sell them. Companies go public for several reasons. According to financial education sources, including SoFi and Cherry Beckert, the common motivation is to raise a large amount of capital that private funding sources can no longer provide. Going public also gives early investors and employees a way to finally convert their ownership stakes into real money, a process known as achieving liquidity, and it raises a company's public profile in ways that private status simply cannot. Now here is where this week's news comes in, and it is genuinely historic. According to reporting from Built-In, ABC News, and The Street, a major aerospace and technology company completed what is being described as the largest IPO in recording history, raising approximately $75 billion and debuting at a valuation of around $1.77 trillion on the Nasdaq under the ticker SPCX. According to ABC News, the company's revenue reached $18.7 billion in 2025, a 33% jump from the prior year, with a significant portion coming from its satellite internet division.
However, despite that revenue growth, ABC News also reports the company posted a net loss of $4.9 billion last year. That gap between strong revenue and significant losses is one of the defining tensions of this IPO. Here is what makes this particular IPO different from most. According to CNBC, Fidelity, and Investing.com, the company reserved up to 30% of its offering for retail investors. That means everyday people like you. Standard practice for a large public offering is to reserve only 5 to 10% for individual investors, with the vast majority going to big institutions. According to Fidelity's own published IPO materials, the offering was made available to any brokerage customer with as little as $2,000 in their account. According to The Street, demand was so intense, reportedly exceeding $100 billion in small investor orders alone, that even qualified buyers who submitted requests walked away with far fewer shares than they sought, or none at all. But here is the part that matters even if you never placed a single order. According to CBS News Philadelphia and Vanguard, once a major company goes public and is added to a stock market index, every index fund and exchange-traded fund that tracks that index is legally required to buy shares of it, automatically. As CBS News reported, 2 major indexes moved to include this newly public company faster than usual, well ahead of the typical 1-year waiting period that normally protects retirement funds from untested new listings. According to certified financial planner sources cited by CBS News, that timeline has raised direct questions about how quickly exposure could reach the retirement savings accounts of millions of people who never made any active decision to invest in this company at all. On the question of whether this IPO represents good value, experts are sharply divided, and that disagreement is itself news. According to CNBC and Fortune, investment research firm Morningstar issued a formal warning ahead of the listing, concluding that the company was, in their words, significantly overvalued. Morningstar valued the company at approximately $780 billion, roughly 55% below the IPO target valuation. Their analysts noted that sustaining the listed valuation through 2030 would require annual revenues exceeding $100 billion. That would demand a compound annual growth rate above 40%, according to Goldman Sachs data cited by TradingKey. On the other side of that debate, according to Yahoo Finance, investment firm ARK Invest holds a far more optimistic outlook, projecting the company could reach an even higher valuation by 2030 based on its satellite, launch, and AI ambitions.
As Trading Key noted, that is a direct disagreement between two credible analytical sources, and individual investors ultimately have to decide which framework matches their own risk tolerance. This one IPO is also widely seen as the opening act of a much larger wave. According to Tech Journal and IG International, two major artificial intelligence companies, one behind the world's most widely used AI assistant and another building AI tools primarily for enterprise customers, have both filed confidential S-1 paperwork with the SEC and are targeting public listings later in 2026. According to Forbes and Reuters, combined, these three listings could attempt to raise close to $200 billion in a single year, a figure that, according to Goldman Sachs projections cited by InMoney, could exceed every dollar raised across all U.S. IPOs in 2021, which was itself a record year. According to IG International, global IPO activity in the first quarter of 2026 alone was already up 45% year-on-year in total capital raised. So what should a regular person take away from all of this? A few things worth knowing. First, IPOs carry real risk. According to Vanguard's investor education materials, IPO access is limited, share allocations are not guaranteed, and newly public stocks can be significantly more volatile than established ones. Second, if you hold a retirement account tied to a broad market index, according to CBS News and WIN News, you may be gaining exposure to newly listed companies without taking any action yourself, simply because of how index inclusion works. Third, analysts disagree sharply on valuation, and according to Morningstar and others, hype around a high-profile listing does not always translate to long-term value. Financial professionals consistently advise that any investment decision, including whether to participate in an IPO or not, should be based on individual financial goals, risk tolerance, and a thorough reading of the company's published disclosures, particularly its SEC-filed prospectus. What to watch next? According to reporting from Tech Journal, Yahoo Finance, and IG International, the AI companies still in the IPO pipeline are expected to make their market debuts in the months ahead, with analysts watching closely to see whether public markets can absorb that level of new supply at these valuation levels. That story is just getting started. If you want to stay on top of every major financial story as it breaks, follow this channel and hit the notification bell. We break it down for you every single day.